Mm.
Okay, class. Good evening. You're welcome to another class on corporate reporting. So tonight, we are going to finish IFRS 16 tonight. Then we'll chart our way forward and look at what we have left to go on corporate reporting. So last week, we started with IFRS 16 on leases, and I made you understand that a lease is also a contract that conveys the right to use an asset for a period in exchange for a consideration. So we have a scenario whereby the owner of an asset conveys the right to use an asset to another person who now has the right to use that asset. The owner of the asset, we call that person or that party a lessor, and the party that has the right to use the asset now, we call him the lessee. And this conveyance of right of use is usually for a period, which we call the lease term, and it's usually in exchange for a consideration, which usually is a lease payment. So we immediately went on to how to identify a lease in a contract. That when you have a contract, how would you know that this contract contains a lease? You said the key word there is right to control. Where the party that is not the owner of the assets, where the party that has the right to use an asset, who is not the owner, where it is that party that has right to control an identified assets, then there is a lease in that contract. And right to control is usually indicated by having the right to obtain substantially all the economic benefit from the use of the identified asset and right to direct the use of that identified asset. So the first one, which is right to obtain substantially all the economic benefits. You see, this is only possible where it is the lessee that is solely using the asset. He's the only one using it. He has to be the only one using it for this A to be possible. For him to have right to obtain substantially all the economic benefits, he must be the only one using it. And the second one is right to direct the use. And this is possible where he takes decision on how he wants to use the assets, what he wants to use the asset for, and the modality is, it takes that decision. Note that for these two items to work, for them to be possible, there must be a specific asset. There must be a specific asset that we can point to that, okay, this is the asset that we have conveyed to the lessee. There has to be, it's very important. Secondly, is that for these two to be possible, the lessor cannot substitute the assets. He doesn't have a substantive right to substitute the assets throughout the use. He cannot. So he cannot just come and say, oh yeah, let's see. Let me have the assets you leased from me 2 years ago. Let me give you another one. No, he cannot substitute. It has to be that singular asset that they will use all through. Of course, events could happen that will necessitate temporary substitution, like where there is a damage on the asset and needs to be repaired. That is quite understandable. Now, the asset needs to be repaired. Therefore, okay, probably they give the lessee an asset pending when the original underlying asset is repaired. So that is allowed. Other than that, no, it cannot be substituted. We solved some questions. I showed you some scenarios just to be sure that you understand how to identify a lease in a contract. And particularly, we also addressed a situation where we have contract with multiple components, where that contract has non-lease component, non-lease, meaning lease is just part of it. There are other parts of the contract that are non-lease. And I gave you a scenario of this guy, a car seat that buys seat from like a seat manufacturer. Eventually, the manufacturer agreed to manufacture a machine, as requested by car seat. So the manufacturer invested so much in the machine, and they agreed that that machine will be used solely for car seats, and it will be used to produce car seat for him in the way he wants it. However, they agree that a minimum payment will be guaranteed to the manufacturer so that he can recover his investments in the machine. So we saw that this is a transaction of multiple components because the core transaction is buying of seed from manufacturer, which is a normal purchase transaction. However, as part of the contract again, there is a lease, which is the fact that there is a machine that belongs to manufacturer, but the person that is obtaining substantially all the economic benefits of the assets is another person who is not the owner, who is car seat, and is even the one directing the use. Is the one that dictated how the machine will be produced, is the one that is dictating what will be produced from the machine, who uses the machine. He has right to control. So there is a lease in this arrangement as well. So we looked at that and we learned about lease term, which is the period over which the lessee has right to use the asset, but it can be extended. And this extension is only possible if the lessee is reasonably certain to exercise that option. So if the lessee is sure that he will exercise, then fine. You're going to consider that extended or that extension as part of the lease term. So if the original lease term is 5 years and they agree that after 5 years, it can be extended by additional 2 years. So if at the inception of the lease, the lessee is reasonably certain, and it can only be reasonably certain if it is favorable for him to extend, then we'll consider that extended period as part of the lease term. And we looked at this example where there was an original lease term of 5 years, the lessee was paying 10,000, and they say you can extend it by 3 years, and I will be paying 5 naira per annum. That's favorable. You were paying 10,000 before, now they ask you to pay 5,000. That is so favorable, and thereby making the lease term to be 5 years plus the extended or the extension, which is a total of 8 years. Then we went on to the core accounting for leases. So we started with lessee. And we said that when a lessee enters into a lease arrangement at the date or at the beginning date or at the commencement date, the lessee would recognize a lease liability and a right of use assets. So it's as good as crediting the lease liability and debiting the right of use assets. And I give you an example why this makes sense. Because that if a lessee enters into a lease arrangement where he's paying 10,000 naira per annum for 5 years, and I asked you, how much will this guy recognize at the commencement date? Some people said 50,000. Some people said present value of 50,000. I mean, the answer is the present value of that 50,000. That is what he will recognize today as liability, because as soon as he enters into that arrangement, he owes the entire 10K per annum for 5 years. He has entered into it. Lease term is a non-cancelable period. So we need to recognize the entire liability at the commencement date. And of course, a corresponding right of use asset representing the underlying asset. The lessee would recognize that in his books. And that is why lease liability, we said that it is initially measured at the present value of the lease payment not paid. Present value of the lease payment not paid at the commencement date. So what I mean is this: if you enter into a lease arrangement, you need to determine all the lease payments you are going to pay over the lease term, get the present value. That is your liability at the commencement date. Usually, the examiner gives you that figure in almost all the questions we have seen in your exam. They give it to you. If they don't give it to you, of course, they will give you the annual rentals that you're going to pay, the period. They will give you the discount factor, most especially in this case, it will be an annuity factor since it's an annual equal payment. So we to get the present value, we're going to use annuity formula to get the annuity factor, which we're going to multiply by the annual amount to get the present value. So when you have that, you get your lease liability. And I also mentioned that these this lease liability cash flows, right, which is basically the lease payments, it could be fixed amount. It's usually considered as part of the lease payment, right, from the outset. It could be variable payments. I mean, if the lease rentals would vary, they will have factored the variation as part of the lease payment as well. And also, I told you if there is any residual value guarantee, that will have also been factored in. And I told you that residual value is just the scrap value of an asset, the value of an asset at the end of its useful life. So in a lease arrangement, the lessee would usually guarantee the lessor a residual value, just to show a good faith to the lessor that, okay, I'm not going to misuse your asset. So he's assuring him that at the end of the lease term, the asset will still have certain value. He's guaranteeing it. Of course, the lessor will not believe him. So they would agree that, why don't you just pay this amount over this lease period, so that after the lease term, you won't have to really, since you're sure you're guaranteeing me, then spread it. So usually the residual value guarantee is usually considered as part of the lease payments, and that makes everybody life easy. And also a purchase option. This would occur where the lessee can buy the assets. They have agreed that he will buy the asset at the end of the lease term and is going to pay an amount called purchase option. So again, this purchase option, they will have factored it in as part of the liability from day one, so that at the end of the lease term, the asset just becomes his own. You won't have to start struggling around, okay, oh, the asset is not good again, I'm not buying again. All of these things will have been agreed in the contract right from the outset. and they will have factored everything into the lease rentals. Okay, so those are components of lease liability. And at the end of the year, at the end of the year, this lease liability, I told you that it will be increased by interest. And we're going to reduce it by lease rentals at the end of each year. And I told you that the reason why we are increasing the liability by interest is because of time value of money. It's because of time value of money. Because we have discounted to get this lease liability at the commencement date. We did a present value. And in reporting, anytime we do present value, as you move through time to unwind the discount. And we usually do that through finance cost. So we debit P&L, we credit the lease liability. We do that at the end of every year. And of course, we solve the question to show this. And you reduce the lease payment, the liability with lease payment at the end of the year as well. And this lease payment, because you're paying, you credit bank, you debit the lease liability. For right of use assets, which is the asset, of course, it is initially measured at the same way as the initial liability, which is the present value of the lease payment not paid. I mean, I told you that what the lessee does at the commencement is to credit the lease liability and credit and debit the right of use asset with the same amount. So the right of use asset is measured initially at the amount of the initial liability, which is the present value of the unpaid lease rental at the commencement date. However, if there is any payment that is made at the commencement date, that should be added. If there's any initial direct cost, that should also be added. If there's any dismantling cost, that should also be added. And this is logical in the sense that if, for example, we have a 10,000 naira per annum lease rentals for 5 years, and at commencement date, you paid, let's say, 10K, 10,000. So that means the unpaid will be like 40,000. So it makes sense that the value of that asset is 40K plus 10K, right? So that entirely shows the entire worth of this transaction, the value we have placed on this asset over the lease term. And that's what the right of use asset is talking about. And of course, when we talk about acquisition of asset, either outrightly or through lease, any initial direct costs of acquiring that asset, like legal costs, like site preparation, like professional fees, all of these must be capitalized. And if at the end of the lease term, we would have to restore the site, we would have to remove the assets, we have to dismantle the assets, that also has to be capitalized. And I hope you remember that it will be capitalized at the present value of that future amount, because dismantling and restoration cost is a cost that will be incurred in the future. So we would estimate a present value for that. That's in line with IS 16. At the end of the year, these right of use assets will be depreciated over the lease term. I repeat, over the lease term. Please remember that right of use asset is depreciated over the lease term, because of course, I know this is the material you're reading for your exams, but in some material, they will tell you that it will be depreciated over the lower of the lease term and the useful life. I mean, we expect the lease term to always be the lower. There won't be any rational situation where a lessee will agree to a lease term that is higher than the useful life. Why would you agree to a lease term that is higher than the useful life of an asset? So you want to pay for a period where the asset is not useful anymore, where the asset is already gone. So that lower, it doesn't work, is usually depreciated over the lease term. So you won't see a question giving you a lease term being higher than the useful life. That's not practical. Okay, so of course, we could use evaluation model to get the value of our asset or right of use asset at the end. That's if the underlying asset is measured using evaluation model, and especially where the underlying asset is an investment property, it's common to use a fair value model. So you would have to use a fair value model too. And when you're using a fair value model, it means the carrying amount of that asset at the end of the useful life is just its fair value. You won't have to depreciate, right? Okay, so that was my core explanation last week. We solved two questions, this one and this other one, to explain all my points to you. And I paid particular attention to this one, this interest and lease payments, the order. I told you that why interest is coming first is because this lease payment is made at the end of every year. That's why interest is coming first. If you had switched it, we won't get the same answer. And I said, and I solved another question where lease payments was deducted before we added interest. And that's a scenario where the lease payment is made at the beginning of every year. And it makes so much sense because unwinding of discounts or interest is usually done at the end of every year, like steady is at the end. So the one that can vary is the lease payment. So if the lease payment is happening at the beginning, it comes first. If the lease payment is happening at the end, it comes last, you know. So note that for your exam. Note when the lease payment is being made. Now, today, we have to finish leases today. And I'm going to be teaching you lessor accounting. So let me focus on that first. Let's focus on it and finish it. For lessor, the guy that owns the asset, IFRS 16 requires that he needs to classify the lease. He needs to understand what type of lease arrangement has he entered into. And there are two classifications. Number one is a finance lease. Number two is an operating lease. So a finance lease is the one where the lessor transfers substantially all the risk and reward incidental to ownership. I mean, simply put, he has sold the assets. I mean, he has transferred substantially all the risk and reward. While operating lease is the reverse of that, meaning he has not transferred substantially all the risk and reward. So for finance lease, the major work is identifying whether a lease is a finance lease or not. Because when it's a finance lease, that means you treat it in line with that. When it is not a finance lease, automatically it is an operating lease. But there are indicators we need to look at to know whether a lease is a finance lease or not, which is the transfer of risk and reward. So when is risk and reward set to be transferred? So number one, which is the area where there's transfer of ownership. So if there will be transfer of ownership at the end of the lease term, that's an indicator. Number two, if there's an option to purchase at a price that is lower than fair value at the exercise date, there's an option to purchase, meaning the lessee can buy the asset at a price that is very low than the price that if he was going to buy a similar asset at that future date, it will be very low because the price is low. So that's also another indicator where there is an option to purchase the underlying asset at a price that is sufficiently lower than the underlying fair value. Three, where the lease term is for a major part of the economic life of the underlying asset. Where the lease term is almost the economic life The lease term is 4 years. The useful life is, let's say, 5 years. Sometimes it could even be 4 years. So what is left for the assets? It as good as he has sold it. Another one is where the present value of the lease payment at the inception date amounts to at least substantially or the fair value of the underlying asset. So where the lease payment is almost equal to the fair value of the asset. So lease payment in the sense of the payment the lessee will pay over the lease term is almost equal to the fair value. It's as good as he sold the asset to the lessee. He's just allowing him to pay over many periods. That's it, where the lease payment is almost equal. Is almost substantially all the fair value. And finally, is the underlying asset is of such a specialized nature that only the lessee can use it without major modification. So this is also an indicator. So these five are primary indicators for a finance lease. You need to know it. You need to know these five. They could ask you. And you would see when you pick each of those key points one by one: transfer of ownership, option to purchase, lease term is major part of the life, lease payment is almost equal to fair value, the asset is specialized. You would note that all these shows that the lessor has sold the assets. All this shows that the asset is not coming back to the lessor. And that is why finance lease is where the lessor has transferred the substantial risk and reward incidental to ownership of the asset. Now, there are other indicators for finance lease. These are not primary. You don't have to really bother yourself about this, but I mean, they exist. So where losses on cancellation are borne by the lessee, where gain or losses on changes in residual value are accrued to the lessee, okay, I think I lost connection a little bit. I'm back up. As I was saying, so you should note this as well. Now, let's go to how do we then account for a finance lease? And I believe we all have the sheer understanding that finance lease is as good as this guy has sold the assets. So with that understanding, at the commencement date, the first thing the lessor would do is to derecognize the underlying assets. He's going to derecognize the underlying assets, and he will recognize a receivable. We call it lease receivable, okay? Or we call it net investment in the lease. We call it lease receivable or net investment in the lease. That is what we call it. So this net investment in the lease or lease receivable, the way it is determined as the present value of the lease payments receivable, which is similar to what the lessee does in his lease liability. That's what this guy is doing. Present value of lease payment receivable by the lessor, meaning all the money is expecting from the lessee. And don't forget, all the money is expecting will include what I told you, the fixed payments. If there's any variable payment, if there will be increase, they will have factored it in. If there is any residual value guaranteed, remember, I told you that would also have been factored in. If there's any purchase option, that is also all of those payments will have been factored in. If they exist, they will have been factored in factored into this present value of the lease payment receivable by the lessor. And we're also going to add present value of any unguaranteed residual value accruing to the lessor. Present value of unguaranteed residual value. You see, why this is coming up is this. Remember, I told you that the lessee would seldomly guarantee residual value. So, of course, the lessor is happy with that, but it might be insatiable at times. It might not be satisfied with what the lessee is guaranteeing. So the lessee can say, okay, this asset, I'm assuring you that at the end of the lease term, you will still be able to get a value of 50,000 naira from it. The lessee can tell the lessor like that. When he says something like that, that 50K becomes a residual value guarantee. And immediately they will factor it into the lease rental the lessee will be paying. But occasionally, the lessor, in fact, in most cases, the lessor will believe that for this guy to say 50,000, that means he can make 80,000. And if he has a firm commitment or belief that he can make that extra 30K, somebody has guaranteed 50K, of course, that person will definitely pay. In fact, they will have factored it in right from the beginning. But he believes he can get extra. So when he's doing his accounting and he's getting his net investment in the lease, he will just simply add it. But since this unguaranteed residual value is something that is coming in the future, so for us to recognize it today, of course, we need to get the present value of that. So that is the entire gist around net investment in the lease and how to determine it. So that is that. And of course, at the end of the year, just like the lessor, I say lessor, just as the lessee has done, it would also increase these investments with interest, and it would decrease it with lease rentals every year. So, and from the way I taught you financial assets, you would have noted that this net investment in the lease is a financial asset because the lessor has a contractual right to receive cash, so it can be impaired or derecognized in line with IFRS 9 if those situations arise. Okay, so now let's solve illustration 5 and this other one. Let's solve 2 questions. Then we'll move to another subtopic very quickly. Any question before we start solving questions? Any questions? Okay, so let's move on. I have a question for you, but I will just hold it. I will hold it until I finish solving all of these questions. Let's look at this first one, illustration 5. So a lessor enters into a 3 years leasing arrangement commencing on 1st January 2003. Under the terms of the lease, the lessee commits to pay 80,000 per annum commencing on 31st December 2003. A residual value guarantee clause requires the lessee pays 40,000 or 40,000 less asset residual value if lower. At the end of the lease term, if the lessor is unable to sell the asset for more than 40,000, the lessor expects to sell the asset based on current expectations for 50,000 at the end of the lease. The interest rate implicit in the lease is 9.2%. The present value of lease payment receivable by the lessor discounted at this rate is 232,502. Required, show the net investment in the lease from 1st January 2003 to 31st December 2005 and explain what happens to the residual value guarantee on 31st December 2005. Okay, so looking at this question, so They told us that a lessor enters into a 3 year leasing arrangement, and the commencement date is January 2003. So the lessee will pay 80,000 every year, pays 80,000 every year, and is paying at the end of every year. So the lessee guaranteed the lessor 40,000. He guaranteed him, and I've explained that to you, that at the end of the lease term is assuring the lessor that he will get 40,000 from the sales of these assets. They now said, or 40,000 less asset residual value, in the sense that if at the end of the lease term the asset was able to do, let's say 20K, it was able to sell it for 20K. So that means what the lessee would give is just extra 20K, just so that the lessor gets that 40K guaranteed, right? Okay. Okay. But if luckily for the lessor is able to sell it more than 40K, then good for him. He makes more money. The next paragraph, he said the lessor expects to sell the assets based on current expectation for 50K. So this is what I was explaining to you, that the lessor will usually not be satisfied with what the lessee is offering as guaranteed residual value. He will believe he can do more. So here he believes he can do 50K, much more than the 40K the lessee is guaranteeing. That means there's a portion of unguaranteed residual value equivalent to 10,000. Okay. They gave us the interest rate implicit in the lease, 9.2%. So basically what we do with this 9.2% is to get our finance income, basically. And like I told you, they would always give you the PV of lease payments. They will always give you in the question. They would always give you in the question. So, what if they don't give you? I mean, it's not like I'm wasting time. We don't have time. We have a lot to do. I just want to be on the safe side. I just want to be safe. What if they don't give us? How would we have computed this? Let me just put a space below. How would you have computed this 232,502? So let's do it together. I've taught you already that is going to be the 80,000, which is the annual amount, multiplied by our what? Our annuity factor. And our annuity factor is 1 minus 1 plus R. In this case, the R is 1092. That's 1 plus 9.2%. 1 plus 9.2%. So that's like 1 plus 0.092. That's 1.092. In this case, raised to power minus 3, because 3 is the least term, divided by 0.092. Okay. So that will be 80,000 multiplied by, do anybody have calculator? Can you press this? What would you get? Anybody?
2.5223.
Okay. So let me multiply it by 80,000. What do we have? What do you have? Tell me.
201,784.
Again, sorry?
201,784.
Okay, so we're not getting the answer. What we have here is 232. What's happening? Why are we not getting the answer? Anybody? Anybody? Oh, we don't have time. Okay, let me tell you. So, yeah. I can't hear you. What did you say?
Wouldn't that be an approximation error?
I didn't hear you.
I said, would it not be approximation error?
No,
No, I was
approximation
going
error.
to say that.
Like 232,000 to 201,000. Like that's not approximation. No. Approximation should be like 2 naira or 3 naira, not a lot like this. It's not approximation.
Okay, could it be the 100 10 naira,
Did they add
10,000
the
naira?
unguaranteed? I don't know that they added the unguaranteed.
The unguaranteed, yes.
Yeah,
The 10,000.
50.
No, that's not the
50,000.
reason.
Then I don't
We
know.
that you're close, but it's not the unguaranteed. It's not the unguaranteed. Ordinarily, this 80,000, what will have factored in as our liability when I was teaching you? I said, in determining the lease liability cash flow, we consider the fixed payment, variable payments, residual value guaranteed, and purchase option. Apparently, for them to have separated this 80,000 from this 40K, this 40K is the residual value guarantee. That means it hasn't been factored into this determination of this 80K. So, and we need to consider it to determine our liability today. Because as far as the lessee is concerned, he has guaranteed the 40,000. So it becomes an obligation to deliver cash. So as soon as you have an obligation that you have no practical ability to avoid, is a liability. That's the conceptual definition of a liability. So that 40K also, we would also need to discount it to present value. So, of course, don't make the mistake of using annuity factor for that. You are definitely going to be using discounting factor, which is 1 plus 9.2% raised to power minus 3.
Minus 3.
Yes, and minus 3. The reason is that this 40K is payable in 3 years' time. So to get the present value of that 40K, we just simply use discounting factor. So got you, when you multiply that, what would you get? 40,000. What is 1.09 raised to power minus 3?
Zero point 768.
0.768. So what do we have? Multiply that by 40,000.
30 points. Sorry, 30,718.
Okay, add this 30,718 to this 201724. What did you get?
23250 501.
Okay, so which is
232502.
okay, so which is this 232502? Which is this 232502. So it is not a fluke. It's not a fluke at all. This is a process for that. And I intentionally did this just for you to see that in determining our liability today, you need to consider the annual lease rentals as well as the residual value guaranteed, right? So that's that now. Okay. In the exam, it's expected that they will give you this. If they don't give you, so that's when that will apply. So now, what this question wants us to do, it said that all they want us to do is show the net investment in the lease from 1st of January 2003 to 31st December 2005 and explain what happens to the residual value guarantee. So straightforward. So the net investment in the lease at commencement date is just the present value of the lease payment receivable by lessor, which they have given us in the question. I've even shown you how to calculate it, 232502. And don't ever forget to also add the present value of unguaranteed residual value. And the unguaranteed residual value here is 10,000, being the 40K guaranteed, which is not up to the lessor's expectation of 50,000. So there's a portion that is unguaranteed. The lessor believes he will get that. It's okay. So he's adding that as part of his expectation, as part of his lease receivable, as part of his net investment in the lease. So we simply discount that to present value, which is 10,000 multiplied by 1 plus 9.2% raised to power minus 3. So that gives us 7679. If you add that to this present value of lease rentals, it gives us 24181. And that is our net investment in the lease at commencement date. So at the end of the year, so moving from this beginning value, which I have as balance brought forward in the first year, I would get my finance income, which is 9.2% of 24181. It gives me 22,000. Of course, that increases my investment in the lease to 262. Then I remove my lease income, right, of 80,000. So it brings the balance to 182,000, which I will carry forward to next year. Then I run the same thing.
Sorry, sir. Please, could you come again?
On which one exactly?
I mean, from the explanation of from January, 1st January.
Okay, I'll come again, but little surprised because this is the same thing as we did in lease liability. So on 1st January, this balance brought forward is 24181 from this value at the beginning. I will add my finance income at 9.2%, which is 22,097, 9.2% of 24181. If I add that together, I get 262,272. Then I remove my lease rentals or the rent I will collect, which is 80,000. Then it gives me 182,278. Then I carry that forward to the next year. Then I run the same thing over and over again for 2004 and 2005. Then I have a balance here at the end of 2005 of 50,000. What I just need you to note here is this, right? This is the same thing as we did for lease liability, nothing different, right? So this lease income is coming after we have added finance income, and that's because the rent is paid at the end of the year. That's when the landlord or the lessor receives the rent. If it were to be at the beginning of the year, remember what I told you for lease liability is to switch. So that means it's the lease income that comes first, then the finance income. So you need to note that, just almost the same methodology. So this is the net investment in the lease from 2003, 2005. So the question also says we should explain this 50,000. See, this 50,000 is just the expectation of the lessor, what the lessor believes he will get. However, from this 50,000, he is sure that the lessee is going to take up 40,000. The lessee will take up 40,000 because it has been guaranteed from the question. So whether he's now able to get the remaining 10,000 or not, so it's really not up to us. But that's the meaning of this 50,000. It's just the value of his investment. So if it is liquidated, fine. If it is not, but he's sure he will get 40,000. He's sure that is going to debit cash with 40K and credit that investment in the lease with 40K, remaining 10K. So that would sort itself out. Okay, so that's that for that question. Now let's solve another
I have
one.
a question.
Okay, go ahead.
at the start of the lease term, there was something you clarified or you reminded us on that the lessor would recognize the underlying assets and will now recognize the receivable equal to the, I think, the net investment in the lease. So if the asset is, say, 50,000 in the balance sheet of the lessor or the company before they lease it, but the net investment in the lease is, say, 60,000, that 10,000, what happens to it?
So you see that if the asset is 50,000
It's already in the books of the entity at 50,000, but the net investment in the lease is
Yeah.
60,000. They were recognizing the 50,000.
Yeah.
Then the difference of 10,000.
Oh, okay, fantastic. Good. Good. So that was what I wanted to ask you. So it's good you asked now. So let me just tell you. So let me use exactly that I was going to ask, but since you have asked, good, let me then actually tell you. So if the asset was 50K in the books of the lessor, so the asset we want to lease, so we leased asset of 50K. So firstly is this, you see, this 50K has to be derecognized, right? We need to derecognize it. I was going to ask you, when I say derecognize, everybody just kept quiet and say, okay, derecognize. You didn't ask. This is a reporting class. It's about double entry. Nobody asked, okay, how do we derecognize? What are we debiting? What are we crediting? Okay, because we don't have time, right? So this 50K, of course, comprises of cost and accumulated depreciation. So just to fast track, we'll have credited the assets with 50,000 and we'll debit disposal accounts with 50,000. That's all we'll have done. So I just actually shorten it, but so the asset account will go off with these credits. It's definitely going to go off our books because that means that's been derecognized. So there's a disposal account now with 50,000 on debit. Now, when you now introduce that net investment in the lease, you see, what you are doing with that net investment in the lease is it's like you are debiting that net investment in the lease because it becomes an asset. It becomes a lease receivable with, how much did you call it? 60K, right?
60,000, yes.
60,000. And you're going to credit that disposal account with 60,000. So the net investment in the lease, then everything I've taught you would then apply. At the end of the year, you increase it with interest, you deduct the lease income like that. So, however, for this disposal account now, the book value was 50K. So the net investment in the lease, which is similar to the sales proceed, is 60,000. So if I may ask you, Robert, what's this 10,000?
That is a gain.
Thank you very much. It goes to P&L. That's a gain on disposal. It goes to P&L. It goes to P&L. So even though I haven't seen any ICANN question asking you this, and they just assume you know, because derecognizing, when I say you derecognize the assets, what I mean is, okay, you have sold it. You remove the asset from your books, and we do that through disposal account. You just take everything relating to that asset, dump it to disposal account. And of course, when you derecognize an asset, you have to, if you are getting nothing, that means the entire 50,000 is going to be loss. Eventually, you close this 50K to P&L as a loss on sale. So if you have received something, this guy was lucky to have received 60K for an asset worth 10K. That's a gain. You take that gain to P&L. So everything balances out. No issue. There's no fluke. Everything has a process. All right. So thanks for asking. You just saved everybody. I will have been the one asking you Then, well, I think you guys would have gotten it correctly anyways. So,
Yeah.
yeah, I know. So let's look at the second question. So Able Leasing co-arranges financing arrangements for its customers for bespoke equipment acquired from manufacturers. Able Leasing lease an item of equipment to a customer commencing on 4 January 2005. The expected economic life of the asset is 8 years. The time of the lease were 8 annual payments of 4 million commencing on 31st December 2005. The lessee guarantees that the residual value of the asset at the end of the lease will be 2 million, although Able Leasing expects to be able to sell it for its part for 3 million. The present value of the lease payment, including the residual value guarantee, was 25.9 million. This was equivalent to the purchase price required. Discuss the accounting treatment of the above lease in the financial statement of Able Leasing for the year ended at 4/0, including relevant. Okay, so the main point here is this. So Able Leasing is the lessor, okay, and starting from 1st January 2005. So the second paragraph, the annual rental is 4 million. The lease time is 8 years. So and of course they are paying the rent at the end of every year. Then there is a guaranteed residual value of 2 million. Although Able Leasing is expecting to sell it for 3 million, that means there's a difference of 1 million unguaranteed. Then they also give us the present value of the lease payment, including the residual value guarantee. So here now they have already told us so that you won't be stressing yourself like the other time. So they already told us that the 25 million has already considered the residual value guaranteed. It's included already. So let's do the account. So very straightforward. For as far as lessor is concerned, so first thing, the net investment in the lease is the PV of the lease payment receivable, which is 25.9 as given in the correction. Then we get the PV of unguaranteed residual value, which is 1 million. And then I will do the present value of that, which is the discount rate or the interest rate implicit in the lease is 6.2%. So 1 plus R becomes 1.02062 raised to power minus 8, because that's minus that 8 is the lease term. So we have 618. If you add that to the 25.9, we get 26,518 as the net investment in the lease. So similar to what we have done before. Similar to what we have done before. So at the end of the year, because they wanted us to, this question is referring to just 2005 alone. So don't bother doing for the 8 years. So at the end of 2005, the lease receivable or the net investment in the lease at the beginning is 26,518, which is this 26,518. You do 6.2% of that 26,518, it gives 1,644. Then the lease rentals, which is 4 million. So by the time you add 26,518 plus 1,644 minus 4 million, that gives us 24,162. Okay. So in my statement of financial position, as at year ended 34 December 2005, under my non-current assets, I'll have my net investment in the lease of 24,162, which is this amount we got here. And in my P&L, I will get my finance income as 1,644 as gotten here as well. So that is it for lessor accounting. That is it for lessor accounting. Okay. Now, still on lessor accounting. So I just want to introduce something to you. It's particularly important for you guys. We call that manufacturer or dealer lessor. which is a lessor that also sells that same asset he has leased out. For example, I am a car dealer, I sell cars. So I now leased one of my car to another party. I didn't sell it, but I leased it to that guy. So I gave him opportunity to pay for so many years instrumentally. Me being a car dealer now, they are referring to me as a manufacturer or dealer lessor. So I leased an item that I ordinarily can sell outrightly because that is what I deal in. I'm a manufacturer of that item. So why is this an issue? Why is this an issue? The reason is this, right? You just want to cover all loopholes. We don't want any opening. Since this guy is also a manufacturer or a dealer or a seller of that item, ordinarily, if he had sold it, he will have made a gross profit, right? He will have made a gross profit. He will have recognized revenue and cost of sales. But because he has leased it out, he might not necessarily go through P&L. That all he will just do is just net investment in the lease, finance income, and all of that I've taught you so far. So, but that won't be right? Because being a finance lease, I told you that it's as good as he has sold the assets. In order not to undermine and understate our profits, we say that this guy must also recognize a gross profit in addition to treating that lease the normal way I've taught you already. In addition to that, he must still recognize a gross profit. That is our concern. A manufacturer or dealer lessor must also recognize a gross profit. And normal, gross profit is revenue minus cost of sales. So the way, and this will just do this in his workings somewhere. So the way he gets the revenue is, what's the fair value of the assets, right? But we cannot rely on fair value alone in this case because he has also leased the assets. So we also have exposure to the present value of the lease payments. So it's the lower of these two that is going to pick and recognize as revenue. The lower of the fair value of the underlying assets and the present value of the lease payments. The lower of the two. We believe that as revenue. That is your revenue because as far as we are concerned, in line with Ifrs 15 that I have taught you, that is the consideration. You see, what you recognize as revenue is the consideration received from the transfer of goods or services. So if he did not get the fair value, of course, if the fair value is not the same thing as the PV of lease payment, what you will ultimately get is the PV of the lease payment. So it's the lower of these two that we would pick and recognize as our revenue. But of course, definitely it should never be higher than the fair value. It should not. If it's higher than fair value, you rather restrict it to fair value. Anyway, that's why it's the lower anyways. Then we remove the cost of the assets. The cost of the assets. So the cost of the assets, which is the cost of sales, right? And the cost of sales is the cost of the assets. However, from this cost, you would also less present value of unguaranteed residual value. So why are we lessing? Why did they even bring this one from in the first place? Why are they lessing present value of unguaranteed residual value? Okay, this is why. Very straightforward. You see, this revenue, we compare the lower of fair value and present value of lease payments. Okay, so really, what we should be comparing this fair value with should have been the net investment in the lease. Because as far as the lessor is concerned, that is what is expecting. Don't forget, is present value of lease plus present value of unguaranteed residual value. That's the net investment in the lease. But if you look at it, they only focused on the lower of fair value and the present value of lease payments. The reason is that we don't want that present value of unguaranteed residual value. We don't want it to come and stain our revenue. That one can never be a candidate for revenue. Present value of unguaranteed residual value. Because the lessor is not even sure whether we will get it. We don't work with revenue that way. Something like that cannot be in our revenue. Something you are not sure that you will get. No, that can never be revenue. That is why they did not consider that present value of unguaranteed residual value. Not that it should have been parts, but revenue has its own way of recognition. So things that you're not sure you will get does not have anything to do with revenue. So we excused it. But in order for it to still have impact, because if you cannot add it to revenue, that present value of unguaranteed residual value, for it to have the same impact on your profits, if you cannot add it to revenue, for it to have the same impact on your profits, reduce it from the cost. Remove it from the cost. It will have the same impact. Abi? So if you cannot add 2 naira to your revenue, remove that 2 naira from your cost now. It's the same thing. It will give you the same gross profit. And that's the reason why we are lessening present value of unguaranteed residual value from the costs, just so that we would have reflected the entire picture around the lesser recognition of net investment in the lease. However, this guy being a manufacturer or dealer lessor, you need to remember in the exam that if they give you this type of scenario, you must always remember to determine a gross profit, which is revenue minus cost of sales. And you need to know that the revenue is the lower of fair value and present value of lease rental, and the cost of sales is the cost minus present value of unguaranteed residual value. So there's a question just for me to put figures to what I've been explaining. So it says that a manufacturer lessor, so that's a dealer lessor or a manufacturer lessor, leases out equipment under a 10-year finance lease. Under a 10-year finance lease, the equipment costs 32 million to manufacture. The normal selling price is 42 million. The present value of lease payment is 38 million. The present value of unguaranteed residual value is 2.2 million. Okay, so that's the question majorly. The second paragraph and third paragraph is the solution. So the manufacturer, we know that he has leased an asset, fine. But being a manufacturer lessor, he also needs to recognize revenue and cost of sales to get profits. So in this case now, the manufacturer, I'm reading the second paragraph, which is the solution. The manufacturer recognizes 38 million. Why 38 million? It's the lower of the fair value of the asset. And what was the fair value of this asset? 42 million. And the present value of the lease rentals, which is 38 million. So we pick the lower, 38 million as the revenue. The cost of sales is the cost of the asset minus the unguaranteed residual value. The cost of the asset is 32 million. In the second sentence, in this illustration 6, the cost of the asset is 32 million. In the last sentence of the first paragraph, the present value of the unguaranteed residual value is 2.2 million. So the cost of sales is 32 million minus that 2.2 million, and that gives me 29.8 million. So my cost of sales is 29.8 million. My revenue is 38 million. My gross profit, of course, will be 8.2 million. 8.2 million. So that has to be recognized. As a manufacturer or dealer lessor, you must recognize gross profit. And when you have done that, then you can then go ahead and recognize your lease receivable or net investment in the lease. In this same scenario, that will be 40.2 million. being the present value of the lease rentals, which is 38 million, and also the present value of the unguaranteed residual value, which is 2.2 million. And that gives us 40.2 million. So that would be what we recognize at the commencement dates. And at the end of each year, we will increase the lease rental by interest and decrease it by lease rentals or by lease income. Okay, so that is it around finance.
Is it not double counting?
Which one?
That question.
Which one are we double counting?
This manufacturer, okay, so we recognize gross profits.
Yes.
So that part is settled because they deal in that asset. Then the other
Yes.
part, that is the lease itself.
Yes.
Now I've created a net investment in the lease.
Yes.
Okay. Then we are recognizing the assets. And the assets in the books of the lessor is 32 million.
Yes.
So if we so there's a difference. That difference now goes to P&L again.
Yes.
It's not double counting.
It's not double counting. It's not double counting. It's not double counting. Even though in your exam, the focus in practice, in real life, you have to do all of that, right? So in your exam, the focus will have been just recognizing this gross profit and your
Profit.
yes. So don't go ahead and start calculating gain on disposal. You know,
Yeah.
if that you asked, I will have asked you just for the double entry sake. Not that I'm not asking you to go and do it in the exam.
Okay. Okay. Thank you.
Okay, so that's
Yeah.
finance, please.
I have a question, please.
Please ask.
Yes, I'm looking at it that since the lease period is over a 10-year period, and now we are recognizing the income as a manufacturer lessor in the first year of the lease. Are we not supposed to spread it throughout the year of the lease, or is it because it's irrevocable and the lessor will bear the cost of breaking the promises or not complying with the terms and conditions of the lease? Because I'm thinking that since it's a 10-year lease, we can spread the income over the period of the lease.
Okay, I think that's a good question. So, which we are doing that really, we are already spreading it through the net investment in the lease. Ultimately, we will do that. However, this is a finance lease, and the substance of a finance lease is that he has sold the assets. Looking at the indicators, for that reason, we believe that he also needs to recognize the gross profits at the date of that transaction, at the commencement date, because this is as good as he has sold the asset. So since he's a manufacturer lessor, right, and ordinarily he sells assets, that's what he does. So just recognize gross profits. It's just like a dummy sale. Recognize gross profits on that same asset, because if you had sold it also, you'll have still recognized a gross profit in your books. So it's just do it like that and recognize the gross profits just for complete capturing of our income and expenses, as well as complying with matching concept totally, which is why we are doing this. So spreading this income it will be done through the actual income that he actually gets, which is the lease income, which he gets on an annual basis, and that is recognized annually every year like that. So we're already spreading it, but we can't spread this gross profit over, because when you even sell goods, you would have recognized it at the date of when you have transferred the goods, and this guy is transferring the goods immediately at the inception of the lease. So, good question. So that's finance lease. That's finance lease. That's finance lease. That's finance lease. That's the one that requires work. Operating lease is quite straightforward. Operating lease is quite straightforward. And what I mean by straightforward is this. So operating lease is that, okay, we haven't transferred risk and reward. So the lessor will have no business recognizing the asset. The asset remains in his books, so nothing touches it. All that happens is the fact that he has conveyed the right to use of the asset to another party who pays him a consideration, lease income. So that lease income is what we just recognize in our P&L as we get it. So very straightforward. So the only thing you just need to note, that you need to remember, is that this lease income, it would be recognized on a straight line basis or another systematic basis that would showcase the pattern of economic benefit from the use of the asset, but popularly is on a straight line basis. And when I say straight line, we mean straight line, meaning equal amount of lease income shall be recognized in the P&L every year. That's the peculiarity of operating lease. Equal amount of lease income shall be recognized in our P&L every year. So this is what I'm saying. Look at this question. This is how you would find it in an ICANN exam like this. This illustration. It says that a lessor leases a property to a lessee under an operating lease. So the examiner already told us that it's an operating lease for 5 years at an annual rate of 100,000. However, the contract states that the first 6 months are rent free. Okay, that's it. That's all they will tell you for operating lease. So the lessor leases out a property for 5 years, and the examiner was very specific that it is an operating lease. So and he's going to be getting 100,000 every year. So you see, it will have been straightforward because all we would have just done is recognize 100,000 in our P&L every year. But they came up with something. They said that the contract states that the first 6 months are rent free, which goes to show that in the first year, what the lessor will receive is not 100,000 because it's giving 6 months rent free. That means in the first year, the lessor would receive 50,000. It's 50,000, half. Does that mean that in the first year we'll recognize 50,000 in P&L, then recognize 100,000 over the remaining periods? That would be wrong because that would have already contravened straight line. Okay, so in order to still achieve straight line, then I then look at it. Since I'm collecting a reduced amount in the first year, that means totally what I'm getting over the 5 years is 450,000, which is the 50,000 in year one, half in year one, then 100,000 for the remaining 4 years. So I'm getting 450. So the best bet for me is to spread that 450 over 5 years equally. And that's how you do it in the exam. So that means what I recognize in my books, in my P&L every year is 90,000. That is how much I recognize in my P&L. So in year one, I recognize 90,000, in year 2, 90, in year 3, 90, in year 4, 90, in year 5, 90. That's it. But it comes with a challenge, right? And this is the challenge. I did this schedule for you to show you the impact of that. So if you look at it, in year one, we say that you recognize 90,000 to your P&L, right? Who can tell me the double entry for this 90,000? Even though I will not ask you what is double entry, but I just believe this is a reporting class. You have to know double entry. Even though you won't really find it too much of it in the exam, but next week now I'll be solving that number one question of last diet. We'll be solving it together. You'll see that you need a good knowledge of double entry for that question one of last diet. You need a relatively good knowledge of double. When we solve it, you will see what I'm talking about. So, which is why I'm trying to tell you the double entry of every transaction that I mentioned in every standard. I mean, most of it anyways. Okay, let's go back to class. What's the double entry for this 90,000?
Debit
The debit
cash,
cash. Because cash is coming in.
50,000.
I
Okay.
need
Then
one
the
person.
debit receivable, 40,000.
Who is talking? Okay, Robert, go ahead. You said what?
Okay, Debbie, please. Debbie can go ahead.
Yeah,
Or you want me to continue?
Deborah, go ahead.
No,
Okay.
Robert, continue. You're saying something already.
Okay.
I'll just say my own when you're done.
The first year, the lessor gave a discount of 50,000 and received only 50,000 naira cash from the question. And we're
Yes.
recognizing 90,000. So we'll debit cash received 50,000, debit a receivable 40,000, then credit PLL 90,000 because this is the lessor's books.
Okay, so you credit P&L, you debit cash, and you debit receivable. With how much?
For the first 40,000.
Okay. I mean, okay. Let me give another person a chance before I come back to you. Deborah, you wanted to say something?
Okay, yes. I was going to say the 50K received, you're going to credit PLL and then debit cash because cash is coming in.
Okay.
Then issues the 40K. Then the 40K. I feel you're still going to receive it, but although you actually spread that amount because I'm looking at it, the 50K will receive half of the year. So I don't know. I don't know about the 40K, but what I'm sure of is the 50K going to
Okay.
cash, debiting the cash. Yeah.
Okay. Good attempt. Any other attempt? Okay. So, okay. All right, go ahead, Jacob.
Okay, so I'm thinking that you're going to debit cash with 50,000 naira in the first year. Then you also debit lease receivable with 40,000, and then you credit the P&L or the PL with 90,000.
Okay. Okay. That's exactly what Robert said. That's exactly what Robert said. Okay. So so I think you guys are correct. The two of you, you're correct. But they are separate transactions, so you just mix the three together. I mean, which is highly logical. You said I will debit interest receivable with 40K. I'll debit cash with 50K. And I'll credit my lease income in my P&L with 90K. So my account balanced. So which is fine, which is very, very fine. Why I can unbundle this one, right? I can pick my 90,000 first, right? And I will say I will debit interest receivable with 90K, because that is like my interest receivable, what I'm expecting. That's my accrued income. Then I will credit my lease income with 90K, right? That's that 90K. That's double entry for that 90K. So this one goes to P&L. So which ordinarily he matches what you guys have actually mentioned. Then the 50,000 that I collected, so I'll simply debit bank or cash with that 50K, right? So I'll just credit my interest receivable with that 50K. So automatically, the balance in my interest receivable, since my interest receivable was 90K before, now I've credited it now with the money I received. So it has now reduced to 40K. So this is the actual double entry that you pass. But you guys use the shortcuts by considering all these three at a stretch. But in real life, I mean, you take it one by one, the income first, then the money you receive second, like that. So good attempt, like good attempt. So following from your responses, so now this 90K is what we are expecting, but this is what we got. So that means there's a lease receivable of 40K. So why this goes to P&L, this one will be under my statement of financial position. Probably put it in current assets, or you can put it in non-current. Either one is fine for this type of scenario, right? So this 40K, since I'm expecting it goes to my, it will be carried forward since it's an asset item. So in the second year, I would also recognize 90K. Okay, so that means I'm expecting 40K plus 90K, which is like 130K. So what I would receive in the second year is 100,000, which is what I should have been receiving. So the balance in my receivable account is now 30, which I will carry forward to the next year. Recognize 90, receive 100, remaining 20. Carry forward to the next year. Recognize 90 in P&L, receive 100, remaining 10. Carry 10 to the next year. Recognize 90 in P&L, receive 100, then it closes off. Okay, so meaning yes, operating lease is straightforward, meaning you recognize lease rental equally over the period, but this is a scenario I can give you in the exam. So you need to understand carefully that you need to still find a way to spread it equally. And the best way we usually do it is we'll look at, okay, how much am I collecting, actually going to receive over the period? Then you divide that over that period, just so that you're recognizing the same amounts to P&L every year. You see, when you do that, it has an impact, because there will be kind of receivable, right, that you also need to recognize in your statement of financial position. So I just intentionally showed you the entire period just to know that it will clear off to zero eventually. Okay. Finally for tonight is sales and leaseback. Sales and leaseback. So I mean, I've taught you a purchase agreement. So this is similar to that, but quite different, but this is a bit easier. So what we are talking about here is where an individual or a corporate entity sells an item and it leases it back. So majorly, we're going to apply IFRS 15, what I taught you in a purchase agreement. However, it's going to be hands-on here, because that's ultimately what would determine the treatment. Okay, So for simplicity, I'm going to look at two scenarios for this sales and leaseback. I'll look at a scenario of where the transfer of the asset is in substance is sale. So when you say you sold, okay, yes, we agree with you. You actually sold, you have sold. Meaning if when we weigh that sale in line with IFRS 15, we saw that you have actually transferred significant risk and reward. So even though you are leasing it back, that is not going to disqualify you, because looking at the substance of the arrangements, it is sale. So if that being the case, that means you become a seller lessee. You immediately become a seller lessee because you sold, you now leased back. And the reason why we are calling you a seller lessee is because we need to recognize a portion of you being a seller because you have sold. And also, we would also need to recognize you being now a lessee. So two things we are doing. So since we have agreed that you have sold these assets, so it's definitely expected that that asset should be derecognized from your books. Of course, I've already taught you that it's going to be through disposal account. So that asset will definitely be derecognized from your books. That's from the standpoint of you being a seller. Now, as a lessee now, then I've already taught you what lessee does. That the lessee will recognize a lease liability and a right of use assets. You already know that. The only difference here is this. For that right of use assets, you see, we have a challenge with that because for us, the asset was actually in your books before. It was in your books before because it was your own. So you sold and leased it back. So right of use asset is also that same asset. Now, in order to block loopholes in reporting, just so that some people will not just enter into an arrangement like this just to overstate their assets. So we now say that the right of use asset you would recognize, we're going to measure it at the proportion of the previous carrying amount, just so that the value of the right of use asset is never going to be higher than the carrying amount of the assets before we recognize it. So the way the right of use assets will be determined will be the previous carrying amount, then we prorate it. We call it right retained, right? Prorate it based on right retained. So which is the discounted lease payment over fair value. So whatever we get here will represent our right of use assets. So that's just the difference. So again, when it comes to sales and lease back, IFRS 15 will come in because the first assessment we need to look at is that, is this sale actually a sale? Because we are wondering, why did you sell an asset when you still need it back? Why did you sell it? So we believe that he's just trying to be smart because why did you sell it? So there's an intention behind it. Is either the guy wants to borrow money or, I mean, majorly that because he needs money. He just wants to use the asset as a collateral. That, okay, I'm selling the asset and I still need it, but so we need to shake the asset and be sure that does this qualify for a sale? And IFRS 15 will guide us on that. So, and when it comes to IFRS 15 guiding us, the ultimate determination is if there has been transfer of risk and reward from one party to another, then we say, okay, he has actually sold these goods or services. So it then becomes a seller lessee. If IFRS 15 agrees that yes, he has sold, it becomes a seller lessee. So being a seller, we would need to derecognize the asset from our books. But don't forget, I just intentionally omit that because that's not the focus. That is going to recognize revenue equivalent to the amount he receives, right? So that one is not our focus here. This is leases. So I'm just focusing on the lease parts, right? So being a seller, let's say, he would recognize the asset from his books, and he will now recognize lease liability and right of use assets. So I then also focus on right of use asset because lease liability is just like I've taught you already. So the right of use asset now, again, just to cover loopholes, we have done it in such a way that he can only recognize a portion of the previous carrying amount. So that's why we determine it this way. Carrying amount multiplied by the discounted lease payments over fair value. That's what you recognize this as right of use. However, he's also going to recognize a gain or loss. Okay, he will also recognize a gain or loss. So here now, being clearly the fact that he's recognizing the asset from his books and is leasing it back. So ordinarily, we didn't mention this earlier on because we believe Robert asked the other time, we believe that this gain should ordinarily be recognized in P&L, right? But in this case now, it cannot recognize everything to P&L. We are going to restrict it as well. We are going to restrict this gain as well for the fact that is leasing the asset back. For the fact that, yes, he has sold, but he's still using the assets. So you cannot recognize an entire gain on such an asset because you are still using it. You
It's
cannot
financial
recognize.
engineering.
Yes. So the total gain primarily is fair value minus carrying amount. That's the total gain on these assets. But we are saying that out of this gain, for the fact that you are still using these assets, this stake 2 is saying that this is a proportion of the gain you cannot recognize. You cannot recognize this portion. So the same ratio we did for determining right of use assets, showing, okay, this is the portion of the carrying amount we believe you are using. Yeah, so this is the portion of the gain we believe you are still using. So you should not, it's not a gain. It's not a gain. So discounted lease payment over fair value multiplied by the gain. So whatever you get in this stage 2, we are saying that portion is not your gain. So stake 3, we call that, okay, this is the gain on the sales, on the rights transferred. This is the actual gain that you should recognize, which is the total gain in stage 1 minus the gain on rights retained in stage 2. Okay, so it is this one that you then recognize in your P&L. I mean, this thing will be more interesting with figures so that you would relate to what I'm talking about clearly. So now let's look at this question. So in April 2002, Net Worth bought an injection molding machine for 600,000. So this is the cost. So the carrying amount as at the end of the next year is 500. So at the beginning of that next year, he now sold the asset for 740. Immediately, he leases it back for 5 years. And he agrees to be paying 160K every year. The present value of all the money he will pay is 700,000. And they say the transaction satisfies IFRS criteria to be recognized as sale. So the examiner don't want you to start bothering yourself around, is this a sale or not? They told you that, okay, IFRS 15 says, okay, it qualifies as sale. So they now say that, what gain should net worth recognize for this as a result of these sales and lease back? What gain should they recognize? Okay, so again, just like I've mentioned theoretically up there, so in figures now, the total gain on this sale is the fair value, which is 740, minus the carrying amount of these assets when it's sold. And the carrying amount was 500. That's the carrying amount. So the total gain is 240. But we are saying that there's a portion of this gain relating to right retained, relating to the portion of this asset you are still using, because you leased it back. So you cannot recognize this entire 240 as your gain in P&L. You leased it back, you are still using it. So it's going to be this 240, prorate it by looking at the discounted lease payment, which they gave us as 700, all upon the fair value, which is 740. So this 227027 cannot be recognized as your gain. So we remove it. So by the time you remove it, which is the total gain minus gain on right retained, then we get gain on right transferred. So it is actually this 12973 that you can then go ahead and recognize in your P&L. No problem. We agree with that. And that's the solution to this particular one. So that explains clearly how you get gain to be recognized in P&L when we have a sales and leaseback. Let's look at another question. Okay, before then now, there's another issue that also needs to be considered, which is a scenario whereby we would have to compare the consideration received with the fair value. Still on the fact that we believe that this transaction is quite fishy, because why would you sell and lease back? So we need to be sure that the money you collected when you sold reflects the fair value of the assets. Just to be sure that the money you collected when you sold, which we call the consideration received, is it reflecting the fair value? So if it is not reflecting, if it is below market terms, okay, if it is, there's number we usually tell you, or you yourself can figure it out, that if the money you received is lower than the fair value of the assets, that's below market terms. I mean, why would you receive a lower amount? So we'll say that that lower amount, that difference, you treat it as a prepayment, of your lease payment. So we believe that the only reason you have agreed to receive a lower amount is because you would be compensated for it too, because you are going to be paying back, Abby. Since you are leasing it back. So the only reason why you accepted to collect a lower money, right, than fair value is because you want to use that reduction, that savings, as an advance payment of your lease. So we treat it as a prepayment. So usually we're going to add it to the right of use assets. That's how we're going to deal with that. But if you have a scenario whereby the money you received is now higher than a fair value, I mean, when we say fair value, IFRS 13, you remember, is the amount received to sell an asset. So what you should receive should be the fair value. So if you're now receiving something higher than that, for us, we believe that excess you have received is an additional loan. It's an additional loan. So that we call above market terms. And of course, as you are paying back your lease rentals, of course, you'll be paying that loan as part of it. So we obviously need to then separate that lease liability into which one relates to the lease itself and which one relates to loan. We need to unbundle it, right? We need to unbundle it and treat them separately. That, okay, that this one relates to lease and this relates to additional financing. So that is that for a seller lessee. And I mean, you would enjoy it better now as soon as I show you some questions to address this. But there's another party called buyer lessor. So I'm not spending any time on this one because I will not really focus on a buyer lessor, because as far as buyer lessor is concerned, the guy, I mean, somebody sold an asset to him. So it's just a normal purchase transaction for him. He has bought an asset. And now he's not a lessor. So the same thing I just taught you today around lessor is exactly how he's going to deal with it. He needs to know, is this a finance or operating lease? Then he treats it accordingly, being a lessor. Okay, so that's for buyer lessor. Now let's go back to this one. Let's go back to it with a question. Let's go back to it with a question. Okay, so net worth sells a building to Risk PLC for 800,000 cash. The carrying amount of the building held to sale was 600,000. Net worth arranges to lease the building back for 5 years at 120,000 per annum payable in arrears. The remaining useful life is 15 years. At the date of sale, the fair value of the building was 750,000 and the interest rate implicit in the lease is 4%. The cumulative present value, okay, they give us the discount factor of 4.452. The transaction satisfy IFRS 15. Okay, account for this transaction. Okay. So again now, so this one, net worth is sold a building for 800. The carrying amount was 600. He now leased it back and is now paying 120 every year. But the fair value of the building is 750. That's the fair value of the building. So firstly, I can see here that he received 800, but the fair value is 750. So that's an additional loan. That extra 50,000 he has received above the fair value is an additional loan. So we need to unbundle the lease liability. So the first thing we need to immediately determine is our lease liability here. That's the first thing you should always do. So my lease liability, they have already given me, they didn't give me my PV of lease rentals, but I have my annual rent that I'm paying, and they already gave me my annuity factor. So if I multiply the two together, I get my lease liability, which is 534,240. However, you see, out of this lease liability, because this 120 is above market terms, considering the fact that he received 800, whereby the fair value of the asset is 750. So there's an extra 50,000 relating to loan, additional finance. So we need to unbundle and take away that 50,000 from this lease liability so that we know that the actual lease liability is 484, why that 50,000 is loan. That has to be very clear first. Now, when that is sorted, then we'll recognize right of use assets also at the commencement date. But like I told you, this right of use asset also, it will be measured based on the proportion of the previous carrying amount, just so that you don't value that right of use above its previous carrying amount. That will not be nice for us. So for that reason, we would need to do a proration. So the previous carrying amount of this asset was 600. So 600 here. So we do 600 multiplied by 484 over 750, right? This 484 is the PV, is the discounted lease payments all upon the fair value. So that gives me this, which is 387,392. This is my right of use asset. And of course, this right of use asset will be depreciated over the lease term, which is 5 years. Okay. Which is 5 years. So Having done that, now I've gotten my lease liability, I've gotten my right of use assets. Then I need to then get the gain on sales, the gain on sales and lease back. So you get the total gain, which is the fair value minus the carrying amount. So that gives me 150. I say that the portion relating to right retained should not be recognized in P&L. So it will be total gain operated by discounted lease payment over fair value. So I'm saying 96,848 should be removed. So from that total gain, so what goes to P&L is 53,152, which is the total gain minus the gain on right retained. And that is it. So in sales and lease back, this is a full question. This has already shown you everything. So you do your lease liability, and if there is any loan, you would remove it. And it could be a prepayment too. If it had been a prepayment, that would have been added to the right of use assets. That is, if the consideration received was lower than the fair value. There's a question like that, which I would require that you would do that yourself, so that I won't be repeating the same thing over and over again. So then, of course, after getting right of use, then you get a gain on sale. So now let me just put everything in a journal for you. Let me put everything in a journal for you. So the money we received when we sold was 800. I debited that. Of course, you know that corresponding credit will have gone to revenue. So right of use assets, I debited that. You know, corresponding credit will have gone to lease liability. So right of use asset, I debited that. Then the building that we derecognized, which is the carrying amount, credited, because we credit the asset. Then both the financial liability, that is the lease liability and the loan together, 534. Then the gain on right retained, 53,000. You see that the debit and the credit will balance up. The credit and the debits will balance up. Now, for your practice, I have 2 more questions here that you need to do and send to me. If you check your handout, you won't find the solution there. Of course, I have the solution here. It's intentional. I intentionally removed it. So just send me your solution, and I'll just share this solution with you. It's extremely important you do it. You try this one. Extremely important you do it. So, and there's another one here, illustration 8. I have the solution here. It is extremely important you do it. You do it, I send you the solution. So the other part is not a problem. Where the transfer, when the examiner tells you that it is not a sale, the examiner will not even ask you this in the exam, because this one is very straightforward. Because if it is not a sale, so that means the seller will not recognize revenue. He will not recognize this. So this one is straightforward. This one, that money you collected, we just treat it as loan. That money, because he said he sold, he collected money. So, and he now leaves the asset back. So we are not saying it's not a sale. So that money he collected is a loan. It's just a financial liability. Whereas the buyer lessor recognizes a financial asset. Okay. So I didn't really solve any question on this one, because there is really nothing to solve here. So there are 2 assignments I'm giving you. This one, illustration 8. Please try it. Try it. Okay, guys. So I'm done for today.
I
Next
have
week.
a question.
Okay, ask.
No, okay, when
Before
you
I go.
finish, please,
Okay,
if
when
you
I'm done.
go up, you painted 2 scenarios
Okay.
with this sale and lease back. The first one is where the consideration is short of the carrying amount. Remember correct? And
Yes,
you said in that scenario, that amount will be considered a prepayment.
correct.
And the second one is if it's in excess, the excess will be considered a loan. Now for the prepayment, that means the first stage of the sale, and that is the sale part, not the lease back part. The sales part. That means it does not even exist at all. There's no sale at all. The money the consideration as the sale is now being taken as prepayment. So that means there's no sale, there's no gain being recognized. I know that is short, so that part is a little bit it's not very clear.
Okay,
I wish
is
we
it
have a
for the
question.
payment?
Is it for the
For the
prepayment?
prepayment,
Is it one of the assignments you are giving us?
yes, which is this
Okay,
one.
for us to try it out. Okay.
Yes. So don't see it as something that's not so straightforward. It's the same thing, the same step, which is why I solved this one for you. The same step. The only thing is that just get the difference between what you received and the fair value. You see that what we received is lower. Just add it to the right of use assets. That's it. So you still sold, you collected money, just that is lower than fair value now. We believe that that's not normal. So that's an advance payment of the lease rentals. So that would add to the right of use asset. So which is this illustration 8 addresses that. You can just try it out and see. We'll discuss it. Okay. That being said, next week we are going to be dealing with IS-21. So the core concept of IS-21 itself is straightforward. So it will take me like an hour or so. So the remaining 1 hour, I will use that to solve last diet question. So we'll be done with IS-21. So that last diet question, you're going to gain a lot from it because I'm seeing them repeating something similar to that. I think that's the order now. I mean, even if it is consolidation, you still need to do a lot of adjustment for standards. So standards are very important now for you guys. So that I'm spending so much time on most of these principles, so you get it very well. And when I'm done with that, then I think that I will immediately go to ratios. I would go to ratios. So that will take like a class as well. So when I'm done with that, I will go to disclosure of non-financial information. So I'm moving away from standards. I'm going to disclosure of non-financial information, which is a 20% of your syllabus. Last day, they didn't ask anything on it. Of course, these days, they will, definitely. And if they don't, I mean, you are fully prepared. You have taught you some other things. So when I'm now done with that, there are some revisions I want to do with you guys. I want to teach you about depreciation and revaluation. You will see that when I'm solving that last diet question, you will see that you will need good knowledge of depreciation and revaluation. And a lot of, and I didn't teach you IS 16, all those standards, 16, 38, 40, 23, all those, I didn't teach you that. But it doesn't mean you won't know it. It's something you have to know because it's an assumed knowledge. These are things we take a lot of time. That is what I teach them in skills. We take a lot, as I'm taking a lot of time teaching you financial instruments, these leases, Ifrs 2, and all of those standards we are taking here. That's how I take a lot of time teaching those guys IS 16, IS 38. So you cannot come here and be teaching that same thing. We won't even have that time. But I know some of you might have forgotten. So I would revise it with you. Mostly that might be our last class. So I think I have like 3 classes, 4 marks. So then we'll end this class on a very good note, hoping that you would read everything we have taught you, together with your past questions. And if you have been reading it, good for you. That means life made easy for you. If you have not, please do. Okay, guys, let's go and rest and get ready for tomorrow's class by 8 a.m. So thank you very much. Have a wonderful night. Good night.